Hello friends, welcome back to JK Shah classes. Today we will be revising a chapter called Special Provisions for Non-Residents and Foreign Companies, mainly for non-residents. This chapter primarily comprises of the rules for calculating or determining residential status for individuals, HUF, AOP, BOI, partnership firm and companies. Thereafter we will be discussing scope of total income, that is RoR, RNOR, NR, then what will be taxable, what will not be taxable, Indian income, foreign income, that concept. Thereafter, we will be discussing some other provisions of the other chapters of the Income Tax Act, which is spread all throughout the Income Tax Act, which are applicable to non-residents. Like for example, section 163, agent of non-resident, then something which we discussed in chapter 12, special rates of tax, chapter 12A, NRI taxation, DTAA, transfer pricing, everything we will be discussing briefly out here. But after finishing, primarily residential status and scope of total income. Plus we will be discussing some income tax rules as well, but starting right now with residential status, section 6, concept of residential status. Section 6 has various sub-clauses or various clauses. Section 6 clause 1 talks about residential status of individuals. Thereafter we have section 6 clause 2, which talks about residential status of HUF, partnership firm includes LLP also, and AOP. And then we have section 6 clause 3, which talks about residential status of companies, Indian company and foreign company, and rest is section 6 clause 4, residential status of all other people, whosoever is left out. So primarily starting with residential status of individuals. As far as individuals are concerned, we can determine the residential status based on number of days of presence. You know about it. Section 6 clause 1, for individual, there are two basic conditions. We call it as BC. Any one of them is fulfilled, either 1 or number 2, either of them is fulfilled, then the individual will be called as resident in India. Which two basic conditions? So two basic conditions, any one have to be fulfilled. Number 1, either that individual is present in India for 182 days or more during the relevant previous year. Relevant previous year means the year for which we are calculating. The second condition has two sub conditions. Both of them have to be fulfilled. Either that person is resident in India, is present in India for 60 days or more during the relevant previous year. His stay in India is 60 days or more, or he is present in India for 60 days or more, plus he is present in India for 365 days or more during the last 4 previous years, immediately preceding the relevant previous year. If you are talking about financial year 24-25, then in 24-25 he should be present for 182 days or more, or in 24-25 he should be present in India for 60 days or more plus 365 days or more in the immediately preceding 4 previous years. Which 4 previous years you know pretty well, ignoring 24-25. So basic conditions: 182 days or more in the current year plus 60 days in the current year, or 365 days or more in the preceding 4 previous years, immediately preceding the relevant previous year. So which 4 previous years are we talking about? So he should be present in India for in 24-25, the current year, for 60 days or more, plus last 4 years combined together, that is 23-24, 23-24, 22-23, 21-22 and 19-20, 20-21. These 4 years combined together 365 days or more. Right, you know this condition. This was there at inter CA level also. This is the basic condition. Now for this resident individual, in case he is resident, then he can be resident and ordinarily resident, or he can be resident but not ordinarily resident. He can be ROR or he can be RNOR. But before we jump to that, which is given in section 6 clause 6, before we jump to that, this basic condition, concept of basic condition given in section 6 clause 1 has got 3 exceptions. In 3 exceptional situations, calculation will not be made exactly in this way. Calculation will be made slightly differently. So first of all, some points to be noted. Number 1, his stay in India, when we say 182 days or more in the current year or 60 days or more, stay in India need not be continuous. He can come in, go back, come in, go back in installment. Total combined together should be 182 days or more. Stay in India need not be at the same place. Sometime he went to this Mahakumbh at Prayagraj, Uttar Pradesh. Sometimes he stayed in Mumbai, Bengaluru, Delhi. He roamed around everywhere. Purpose of stay is also immaterial, whether he came for vacation or commercial purpose or business. Day of entering into India, this is an important point. The date on which he enters into India and the day of leaving India, both will be counted as one full day. 1 full day of stay in India, meaning thereby he comes to India on 11th April 2024 at let's say he came to India at 11 p.m. at night, 11 p.m. and then 12:05 p.m. he has a connecting flight, 12:05, or maybe he came to India, he stayed for few hours and it's at 2 o'clock his flight is 2 o'clock, let's say, to be on a safer side. That means 2 o'clock would be changing the date will get changed to 12th April 2024. Then he will be deemed to be present in India not for this 3-4 hours, he will be deemed to be present in India for 1 and 2 full days. Okay, then for individuals who are crew members, that means staff members, crew members of an Indian ship or foreign going ship, will be calculated slightly differently as per rule 126. Whichever country's ship may be, but if the ship is going from India to abroad, it is called foreign bound ship, then calculation will be made slightly differently. What is it? We will be discussing. India includes not only the land mass of India, India includes territorial waters of India also. Like for example, this is India, this is land mass of India, this is definitely in India. If somebody is outside the India but within the territorial waters would be up to 12 nautical miles from the landmass of India. Then up to 12 nautical miles it will be considered as Indian water or Indian territorial water. That person will be deemed to be present in India. Okay, so India includes territorial waters apart from the landmass up to 12 nautical miles. 7 point leap year, once in 4 years. Leap year, February month has got 29 days, so you will have to be very careful while calculating number of days of presence in the immediately preceding 4 years. Out of 4 years preceding the current year, 1 year will definitely be a leap year. So your current year applicable to you is financial year 24-25. That is not a leap year, but immediately preceding 4 years, 23-24 was a leap year. Be careful about it. And a person can be resident of more than one country in the same year, which you know pretty well. Then what to do? Then nothing to be done as such for this chapter. But if it comes to DTAA chapter, then we know pretty well there is something called tiebreaker rule. Okay. Now, one question came in the exam for 5 marks that somebody wants to come to India and he wants to stay in India for almost 1 year. He wants to stay into Indian border, India for almost 1 whole year, but without becoming resident at all. So, how to do the tax planning for him without attracting the provision, without making him resident? He does not want to become resident of India. So, in such situation, you should plan out a stay in India spread over 2 different financial years adjoining each other in such a way that he does not become resident in India in either of the years. For example, he comes to India in previous year 23-24. Previous year 23-24 he comes to India on 3rd October 2023. Till 31st March he would be present in India for exactly 181 days. How? So October month he would be present. He came to India on 3rd October. That means first 2 days he was not there. So he was there in India for 29 days. November 30 days, December 31 days, January 31 days, February 29 days this time. That's why be careful. 29 and March 31 days, total will be 181 days. And then in the next financial year, that is in the current financial year 24-25, he should leave India somewhere on 30th, not 30th, but let's say 28th September 2024. Again he would be in India for 181 days. Totaling to 362 days, you can calculate it out, which is almost 1 year, but little less than 1 year, but almost 1 year. 181 how? So April 30 days, May 31 days, June 30 days, July 31 days, August 31 days and September 28 days. This came for 5 marks in the exam, so be careful about it. When the clients approach us, we have to have a ready answer to client's query. 3rd October till 31st March 181 days, 1st April to 20th September again 181 days, total 362 days. Solution is provided. Okay. Now this basic condition, 2 basic conditions have 3 exceptions. I have named them as category 1, category 2, category 3. Which 3 exceptions are there? So first understand, out of the 3 exceptions, 2 of them are governed by explanation. First exception is explanation 1 clause A, second exception is explanation 1 clause B, and the third exception is by virtue of the next clause, section 6 clause 1A. First two are explanation 1 clause A to section 6(1). Second one is also explanation 1 clause B to section 6 clause 1. But the third one is the next clause, section 6 clause 1A. Okay, in real life we talk in terms of clause numbers and section numbers and subsection number. You should be for this chapter little bit aware of the clause numbers. Okay, first exception, what is it? I have called them as category 1, 2 and 3. Category 1, category 2 and the last one we'll call it as category 3. Category 1 to 3, there is no concept called category 1 to 3. Category 1 to 3 names are given by me or us for our easy understanding. So starting with category 1, category 1, that is explanation 1 clause A, it says two basic conditions. What are the two basic conditions? First one is 182 days or more in the current previous year, or second has two sub conditions, 60 days or more in the current previous year, plus 365 days or more in the last immediately preceding last four previous years. Now here the first basic condition will remain intact. Second basic condition A part, instead of 60 days will be replaced by 182 days in case of first exception. What is first exception? You know pretty well. I'll show it to you, but before that, first basic condition, first basic condition will remain intact, 182 days or more. Second basic conditions part A will be changed from 60 days, it will become 182 days, making this second basic condition totally redundant. For which kind of people? Answer, it is applicable to those who are citizens of India. Remember very carefully, it is only for citizens of India. Citizen of India like you and me, but living abroad, going abroad in the current previous year for either employment or as a crew member of Indian ship, going for employment outside India. Employment includes not only job, employment includes business, profession, employment, everything. But if he is going as a student for studies or going for vacation, then this exception will not apply. Exception will apply only if he is leaving India in the current year for employment outside India. Employment will include job, business, profession, all three, but does not include going for studies, further studies or vacation. So what to do? The second basic condition, part A, 60 days to be replaced by 182 days, and if this is replaced by 182 days, if 182 days condition is fulfilled, part A is fulfilled, then no need to check part B, because if part A is fulfilled, then first basic condition itself is fulfilled. First basic condition is fulfilled, that person becomes a resident automatically without being present in India for 365 days or more in the last four preceding previous year. Secondly, simply making the second basic condition totally redundant, check only first basic condition, that is satisfied, he will be a resident. Which kind of people? Number one, following three exceptional cases. The first one is category 1, explanation 1 clause A to section 6(1), citizen of India who leaves India, who's like you and me staying in India only, but leaves India in any year for employment outside India or as a crew member of an Indian ship. Though it says leaving India in any year should be understood as current year only. This benefit is not available every year, meaning thereby this benefit is available only for that year in which he leaves India. Next year, this exception category 1 will not apply. Next year another exception may be applicable, but this exception will not apply. This exception is only for the first year, the year in which he leaves India. What to do? Then he will be resident in India if he satisfies first basic condition as it is. Second, part A, 60 days to be replaced by 182 days, 365 days will remain intact. Simply second basic condition not to be checked. He will be resident if he fulfills the first basic condition. Second exception, I call it as category 2. It is governed by explanation 1 clause B to section 6 clause 1. What is it? This is applicable for citizen of India or a person who is person of Indian origin. Either citizen of India or individual is a person of Indian origin. What do you mean by person of Indian origin? Person of Indian origin means a person who either he himself was born in undivided India, or any of his parents were born in undivided India, or any of his grandparents were born in undivided India. Undivided India would mean India, Pakistan, Bangladesh, all three before partition. After partition only India. Which people should have been born and brought up in India or born in India? Either that person he himself or any of his parents or any of his grandparents. Grandparents will include maternal as well as paternal, both the types of grandparents, but other than those who are covered by category 3. So the bracketed wording other than those covered by category 3, you will realize the relevance of this sentence or the bracketed wordings only after finishing category 3. Category 3 meaning thereby if there is a clash between category 2 and category 3, means the person is covered by category 2 also and category 3 also, then because of bracketed wording category 3 will prevail over category 2. Category 3 will supersede category 2 in case the person is covered by both the categories. Citizen of India who lives outside India means not the person who lives in India leaving India, no, that will be person covered by category 1. Category 2 he is living abroad only, but he comes to India for a visit and his total income other than income from foreign sources. What does this mean? Total income other than income from foreign sources. Total income other than from foreign sources would mean Indian income. If his Indian income exceeds 15 lakhs, Indian income exceeds 15 lakh rupees, then he will be covered by this second exception. Then something is clarified out here which I will come back in 2 minutes, give me 2 minutes time. So in case the person is citizen of India or a person of Indian origin living outside India comes to India for a visit and his Indian income is up to 15 lakhs, then no problem. Whatever we discuss in the first exception, same rule will apply here. First basic condition 182 days or more. Second basic condition, second part again 365 days or more in the preceding 4 years, everything will remain same, only the first part of the second basic condition 60 days to be replaced by 182. That we were doing otherwise also in category 1. Answer, this is exactly like category 1 provided his Indian income is up to 15 lakh. If his Indian income exceeds 15 lakh then that will create problem. If his Indian income is more than 15 lakh rupees, but which income? Answer, total income. It does not say net income or gross income, by default gross income. Then he will be resident in India in case he fulfills first basic condition. First basic condition will remain intact 182 days or more. Second basic condition part B will also remain same 365 days or more in the last 4 previous years. What will get changed is only second basic conditions first part. First part which was supposed to be 60 days, 60 days here will be replaced by 120 days. 60 days double 120 days or more. Then he will be resident in India. But don't see only this 120 days condition. Apart from 120 days condition, another condition in the last preceding 4 previous years he should have had been in India for 365 days or more. That condition also is equally relevant. Okay, both of them are fulfilled, then only we can say that the condition number B or basic condition number 2 is fully fulfilled, either A or B. And then there is a clarification that if this person becomes resident in India because of this second basic condition, which is to be read in conjunction with this point that Indian income exceeds 15 lakh, because of this he becomes a resident in India, then according to section 6 clause 6 subclause C, he will be, according to this he is becoming, according to explanation 1 clause B, he is becoming deemed resident. We will call him as deemed resident. Such deemed resident person according to 6(6)(c), he will be deemed to be RNOR, provided he is deemed to be, he will be deemed to be RNOR. In order to decide whether he is ROR or RNOR, we have 2 additional conditions, you know about it. Without checking those additional conditions, he will straight away be RNOR, provided what? Provided his Indian income exceeds 15 lakhs and he becomes a resident in India in the current year because of condition number 2, second basic condition, not because of first basic condition. If he becomes resident in India because of first basic condition, then in order to decide whether ROR or RNOR, you will have to check both the additional conditions. However, if he becomes a resident in India because of second basic condition, then you don't have to bother about additional conditions. Even if additional conditions, there are 2 additional conditions, you know about it. Even if 2 additional conditions are not satisfied, then also he will be deemed to be RNOR. Or even if they are both satisfied, then also he will be deemed to be RNOR. Okay, provided his Indian income exceeds 15 lakhs and he becomes a resident in India because of second basic condition. So for second basic condition, you need to understand that his last 4 years stay period should be 365 days or more, plus part A, his presence in India, stay in India should be 120 days or more. But I also told you that he should be becoming resident because of second basic condition and not because of first basic condition. So to avoid applicability of first basic condition, you need to clarify that he should be present in India in the current year for greater than or equal to 120 days but less than or equal to 181 days. Up to 181 days he should be present in India. Then only second basic condition gets fulfilled. In case his stay in India is great, see 120 days is already given to you, greater than or equal to 120. That condition has to be fulfilled. But as far as the second one is concerned, which is written by me, not given directly in the act, that is indirectly given in the act. How it is indirectly given? In case he breaches this condition, he becomes resident in India because of 182 days, because of first basic condition. Then you will have to check additional conditions also in order to find out whether he is RoR or RNOR. So according to section 6 clause 6 subclause C, such deemed resident will also be deemed to be RNOR in case his stay period is greater than or equal to 120 days but less than or equal to 181 days. Less than or equal to 181 days is same as less than 182 days. So whether you write it as less than 182 days or you call it as less than or equal to 181 days, idea is up to 181 days. This is an important point, keep it in your mind. Then we kept one point pending. What do you mean by Indian income? This is applicable only if his Indian income exceeds 15 lakh rupees, but it is not directly given that Indian income should exceed 15 lakh. It says income, that is total income, other than income from foreign sources. Other than income from foreign sources, which means Indian income. However, there are two incomes which are actually foreign income but will still be considered as Indian income. There are two foreign incomes. Foreign income means an income which is accruing or deemed to be accruing outside India, received or deemed to be received outside India. There are two foreign incomes which are actually foreign income but will be considered as Indian income for the purpose of this particular calculation. Which two income? Number one, income from business controlled from India or income from profession set up in India. Income from business controlled from in India or income from profession set up in India. These two incomes which are actually foreign incomes, they are income accruing arising outside India. Except of these two incomes will be counted as Indian income, which is not deemed to accrue or arise in India. That is okay, but ideally in spite of being foreign income, these two incomes from business or profession set up in India or controlled from India will be considered to be Indian income and not foreign income. Now the third category exception, third and the last exception. Then I have one more category, but before we proceed further, let me clarify it to you, or let me remind you. Category 1, person should be citizen of India. Category 2, person should be either citizen of India or he should be a person of Indian origin. Category 3, again he should be citizen of India. So category 1 and 3 benefits are given only to those who are citizens of India. Category 2, it is only category 2 where the person could be PIO also. Otherwise he has to be resident, he has to be citizen of India. Otherwise he has to be citizen of India. Meaning thereby benefits are not available to non-Indian citizens. Foreigners cannot claim these exceptions. Foreigners will be compelled to calculate or determine residential status as per original basic condition only. Second basic condition 60 days or more, and second basic condition is 365 days or more in the preceding 4 previous years. I hope you people are following it. You are done with it at inter CA level also, and you are doing it again at final CA stage. There is a duplication, but this chapter is slightly relevant from exam perspective. That's why we are doing it. Okay, section 6 clause 1a. It is not subsection 1a, it is clause 1a. Newly introduced in AY 21-22 by Nirmala Sitharaman ji. Again applicable to a person who is citizen of India. An individual who is not covered by category, it should be category 2. Category 4. Category 4 means the general exception, or you can delete these bracketed wordings. Okay, individual who is citizen of India. This benefit is only for citizen of India. Whether he is PIO or not, that is immaterial. He should be citizen of India. Recently I came across one case where the person, father was born and brought up in India, but child who is now 23 years of age, he is going to start earning income. That 23-year-old boy, he is not a citizen of India. He is the OCI card holder, Overseas Citizens of India card holder. That means he is PIO. That means he is a person of Indian origin, but he is not a citizen of India. He cannot fall under exception number 1 and exception number 3. At the max, being PIO, he can be covered under exception number 2. Okay, whereby his Indian income should be greater than 15 lakh. Here also Indian income should be exceeding 15 lakh. Understand? And is not liable to. Condition 1 is citizen of India, and condition number 2, dual condition, he is not liable to tax in any other country or territory other than India by reason of his residence or reason of his domicile. It doesn't say that he is not liable to tax in any country. It says not liable to tax in any other country because of the reason of his residency or domiciliary. Meaning thereby he is not getting taxed in that other country because he is not a resident of that country or not domiciled in that country. That is why he is not getting taxed there. He might be getting taxed in that other country because of the reason that he has earned income there, because his income is accrued. Supposing I go to USA for one day and my income accrues there, but that income is taxable in USA, not because I am not resident or resident of USA, because I earned income there, my income is accrued there. That's why it is taxable. So here it says person who is not liable to be taxed in that foreign country or any foreign country by reason of his residency or domicile. It is quite possible that that person is taxable in that given country because of income accruing in that country. That's a different thing that we are not counting. So it's not ultimately that he is not liable to tax in any country. We are saying not liable to tax in that country because of his residency in that country and his total income, that is Indian income. So Indian income, how did we know that it should be Indian income? Bracketed wordings. Total income other than income from foreign sources. Other than income from foreign sources, that means Indian income. If his Indian income exceeds 15 lakh, but Indian income will include two types of foreign income. Such a foreign income which is earned from business control from India or a profession set up in India, these two will be considered at par with Indian income. Actual Indian income plus deemed Indian income, and such incomes are not deemed to accrue or arise in India, then he will be covered by exception number 3. Now step number 2, check his total income excluding foreign income, that is Indian income. Indian income exceeds 15 lakh, Indian income exceeds or does not exceed 15 lakh, exceeds 15 lakh, does not exceed 15 lakh. What to do? The answer, if it does not exceed 15 lakhs, no, then whatever basic conditions originally we discussed, subject to condition that 60 days should be replaced by 182 days. First condition 182 days or more, second basic condition 60 days should be replaced by 182 days. Same as category 1. So category 1 and category 3 both the places provisions are same. Category 1 was citizen of India leaving India for employment outside India, and here irrespective of his total income, irrespective of whether Indian income exceeds 15 lakhs or does not exceed 15 lakh, but here we will have to check his Indian income also. If Indian income is up to 15 lakh, no need to worry, he will be deemed to be resident in India only if he fulfills first basic condition. Second basic condition not to be checked, because in second A 60 days time limit is to be replaced by 182. In case he is in India for 182 days or more in the current year, he will automatically be fulfilling first basic condition. No need to check second basic condition at all. He is automatically resident. However, if his Indian income exceeds 15 lakh, this is the most important category. Number 1, he is an individual, plus number 2 is not liable to be taxed in any other country by reason of his domiciliary or by reason of his residency in that country. That is second condition. And third condition is, number 1, he is citizen of India, may or may not be person of Indian origin, but he should be citizen of India, plus his Indian income exceeds 15 lakh rupees. Before that, the second condition is he is not liable to be taxed in any country by reason of his residency or domiciliary. And third condition, Indian income exceeds 15 lakh, then no need to check the number of days of presence in India. No need to check how many days he came to India. Straight away, such deemed resident will be deemed to be, he will be deemed to be resident irrespective of the number of days of presence in India, but he will be deemed to be RNOR also as per section 6 clause 6 subclause D, 66D. So quickly brushing up, category 1, 2, 3, category 1, category 2, category 3. Category 1, is it for citizen of India? Citizen of India, person of Indian origin, PIO. The answer, PIO concept, he should be citizen. Citizens will be covered by all the 3 exceptions, but PIO will be covered only by second exception, will not be covered by first and the third exception. Be careful about it. Secondly, when we say Indian income exceeds 15 lakhs, for these 2 points, category 2 and 3, Indian income should exceed 15 lakhs. For category 1, there is no such condition with regards to amount of income. Irrespective of the amount of Indian income, it will be like this. Are you able to follow? Here what will happen? First basic condition will remain intact. Second A, 60 days to be replaced by 120 days. And second B, 365 days or more in the last 4 preceding previous year, no changes. So I'm putting a dash. I hope you people are able to read my handwritings. 60 days or more to be replaced by 120 days in cases Indian income exceeds 15 lakh rupees, and 365 days or more in the preceding 4 previous year, that condition remains same. Category 3 is little amusing. Here basic condition, first basic condition will remain intact, 182 days or more in the current year. Second A part, 60 days or more and plus 365 days or more in the preceding 4 previous years. If he is not, category 3 means not liable to be taxed in any country. Not liable to be taxed in any country by reason of his so and so, he will be deemed to be resident in India, and accordingly Indian government will be able to charge him tax. Nomadic people, not resident of any country in the world, they keep on traveling to different countries. Everywhere they stay for few days, 5-6 days, 1 week maximum, and they leave that country, go to another country. In such situation, 60 days, nothing to be checked. Second basic condition or the first basic condition are not to be seen only. He will be deemed to be resident of India in case he fulfills first basic condition. These conditions are to be checked. I don't know why did I cancel it. Not to be cancelled, it's just that 60 days, what to do with 60 days? Nothing doing. Number of days of presence in the current year not to be seen only. Even if he does not come to India for a single day, even if he is present in India for 0 days, then also basic condition not to be checked, he will be deemed to be RNOR. Not only deemed resident, such deemed resident will be deemed to be RNOR, and all the provisions of the act for RNOR will be applicable to him. We follow this. That was category 1, 2, 3. So let me remind you, category 1, 2 and 3, Indian income to be checked only for category 2 and category 3. Indian income should exceed 15 lakh. That condition is to be seen only for category 1. There is no exception. Category 1 is for people like you and me going abroad in the current year for employment outside India. Category 2 is for citizens who are residing outside India. They come to India for a visit and Indian income is more than 15 lakhs. Then Indian government does not want to let go that income which is supposed to be offered to tax. Indian government would want to charge a tax. What is the language of category 2? Category 2 is presence in India is 120 days or more. Indian income is more than 15 lakhs. He will be RNOR in India. And for category 3, come what may be, Indian income exceeds 15. Indian income should exceed 15 lakh only for category 2 and 3. Only for category 2 he should be, or he could have been PIO also, apart from only being citizen of India. Everywhere citizenship is to be taken into account. For the first time, our government says also check, apart from his number of days of stay, also check whether he is taxable in other countries or not, or check whether he is PIO or not. 3 exception. Last category is category 4, which is nothing new. It is the original 2 basic conditions which we have converted into the next exception. This is category 4. Original 2 basic conditions not to be checked only. And he will be deemed to be RNOR irrespective of his number of days of stay in India. So which places his income should be more than 15 lakh? Indian income, category 2 and category 3. Where should he be PIO? He could be PIO only for category 2, not for category 1 or category 3. Category 1, income not to be seen. Income to be seen, Indian income is how much? That is to be seen only for category 2 and 3. Whether he is person of Indian origin or not, that is not to be seen. He should be citizen of India for all the 3 exceptions. Person of Indian origin is to be taken into account, origination only for the purpose of category number 2. Okay. And what if there is a clash between category 2 and 3? Indian income is more than 15 lakh, but there is a clash. He came to India, though his number of days of presence not to be seen, this one, he will be deemed to be RNOR, deemed to be resident, and deemed to be resident but not ordinarily resident, and accordingly his residential status will be decided as per these criteria. Hope you people are clear. Now last category which I have categorized as category 4, but there is nothing called category 4. Category 4 is original basic conditions. All other individuals other than those covered by category 1, 2, 3, those who are covered by category 1, make them fall under category 1. Those who are covered by category 2, make them fall under category 2. Same way with category 3, if the person is not covered by either of the 3 categories, then he will be resident in India if he fulfills original 2 basic conditions. Stay in India is 182 days or more in the current year, stay in India is 60 days or more in the current year, and 365 days or more in the immediately 4 preceding previous year. Okay, now once the residential status is decided, then for individuals, once an individual is resident in India, he may be ROR or RNOR. Person whose resident individual, it could be ROR or RNOR, depending upon 2 additional conditions. Both are fulfilled. Additional conditions are given in section 6 clause 6. How many additional conditions are there? There are 2 additional conditions given in section 6 clause 6. Subclause A, subclause B. One by one we will be discussing. Proceeding further. Section 6 clause 6 subclause A, section 6 subclause 6 clause 6 subclause B. A resident individual may be ROR or RNOR. Which are the 2 additional conditions? Number 1, if he is present in India for 730 days or more, that is second additional condition, 730 days or more in immediately preceding 7 previous years preceding the current year. Current year is to be ignored, go backwards, last 7 years. Same way, first additional condition requires us to go backwards 10 years. In the last 10 preceding previous years, last 10 years, he was resident in India for any 2 or more than 2 previous years, 2 or more than 2 previous years in immediately preceding 10 previous years. Last 10 years he should be resident in India in any 2 or more than 2 years, plus both the additional conditions have to be fulfilled. In the last 10 previous years he was resident in 2 out of 10, plus last 7 years he was present in India for 730 days or more. If both of them are fulfilled, then he will be ROR. Any other possibility, he will be RNOR if he fulfills only one additional condition or none of the additional condition. Only one or none out of the 2 additional condition, he will be RNOR. How does it matter? That we will be discussing in the next section, section 5, scope of total income. So this is how it is. You will have to remember these 2 additional conditions by heart. However, these 2 additional conditions not applicable for category 2 and category 3 type of people. Category 2 means becoming resident in India, deemed resident because of present in India for 120 days or more, but less than 182 days, and his Indian income is more than 15 lakh, plus he is citizen of India or person of Indian origin, if you recollect. So section 6 clause 6 subclause C, that is category 2. Category 2 means person who is citizen of India or PIO who lives outside India, comes to India for visit, plus Indian income exceeds 15 lakh rupees. That's the second condition. 15 lakh this is. Then he will be deemed to be resident in India in case he is present in India for 182 days or more, or second condition part 1 is instead of 60 days it will be 120 days or more, and second basic condition is he was present in India for 365 days or more in the immediately preceding 4 previous year. In case he becomes resident in India because of the second basic condition 120 days or more, and he does not fulfill the first basic condition, that means his stay in India is less than 182 days, plus he is present in India in the last 4 previous years for 365 days or more, in the last 4 previous years, then he will be deemed to be RNOR automatically. Category 2 people, Indian income should exceed 15 lakh rupees, he will be deemed to be RNOR automatically without checking the additional condition. And the last one is section 6, clause 6, subclause D, that is those who fall under category 3. Category 3 is only for citizen of India. If you observe category 1, 2 and 3, in category 1 and 3 he should be, category 1 and 3 is only for citizens of India. Category 2 is for citizen of India or a person of Indian origin. So person of Indian origin is covered only by category 2. Individual who is deemed to be resident in India, irrespective of his number of days of stay, that is his citizen, plus Indian income exceeds 15 lakh rupees, plus not liable to be taxed or not taxable in any other country. Not taxable in any other country because of his reason of his residency or domiciliary. Not taxable in any other country or a territory. Then 2 additional conditions not to be checked. He will be, this guy is covered by section 6 clause 1a, that is category 3. He will be deemed to be RNOR automatically. Deemed to be RNOR, that is deemed to be resident but not ordinarily resident automatically without checking the additional condition. Now what will happen if the person being individual turns out to be non-resident? Answer, if he turns out to be non-resident, then in rate of tax it will make no difference. Rate of tax for non-residents are exactly same as rate of tax for residents. Whether it is old tax regime OTR or it is new tax regime of section 115 BSC subsection 1A, both are same. The only thing is that in old tax regime the basic exemption limit is 2.5 lakh, but available to resident senior citizen is 3 lakhs and resident very senior citizen is 5 lakhs. The 3 lakh and 5 lakh will not be available to non-resident. It is only for resident senior citizen and very resident senior citizen. Then rate of surcharge and rate of health and education says this will also be exactly same for resident and non-resident. 0% if the income is up to 50 lakhs, 10% surcharge will be at the rate of 10% of tax if the net income is more than 50 lakh but up to 1 crore. 15% if the net income is more than 1 crore but up to 2 crore. 25% if the net income is more than 2 crore but up to 5 crore, and 37% if the net income is more than 5 crore. Health and education says will be 4% of tax plus surcharge for resident also, non-resident also. 87A rebate not available to non-resident, it is only for residents, only for resident individual. Under old tax regime also and the new tax regime also, it is only for residents. Now residential status of HUF. As far as HUFs are concerned, no, the concept is same concept is applicable for partnership firm also, AOP also, and firm includes LLP. So I am writing LLP separately. Same concept for HUF also, but then also, and the section number, clause number is also same. Section 6 clause 2. 6.1 was for individuals and 6.2 is for other people, these people. However, for HUF we will discuss separately, and for partnership firm AOP LLP we will discuss separately. Reason being very simple, that HUF can be, apart from being resident, it can be RoR, RNOR also. But partnership firm AOP LLP can be only resident or non-resident. They cannot be RoR, RNOR. So right now for HUF combined together, for HUF and other 3 people, the residential status will depend upon location of control and management of affairs. Control and management of affair, 3 possibility, could be wholly in India, or it could be wholly outside India, or it could be partly in India, partly outside India. If the management is totally in India, then naturally goes without saying they will be resident. Which people are we talking about? HUF, AOP, LLP, partnership firm. Okay, if the management is wholly in India, then resident. Management wholly outside India, then non-resident. So if it is wholly, then no problem. Problematic child is only when partly in India, partly outside India, and that time you don't have to use your brain. You have to remember that the person HUF or partnership firm etc. will be resident in India. Same way for partnership firm AOP BOI, resident, resident, and in between there will be non-resident. When will they be non-resident? So only possibility you need to remember from exam perspective is when will these people be non-resident. Remaining all is a fill in the blanks. Everywhere it will be resident. The only way of becoming non-resident in India is to have the management and control wholly outside India. But which control, which management? So answer de facto control. What do you mean by de facto? De facto means actual control and not only the power to control, not only having a right to control the management and affairs of the HUF, but having the actual control, person who exercises the actual control. Okay, so just remember management wholly outside India, then non-resident, otherwise resident. Now out of them only HUF which is resident in India can be ROR, can be RNOR. Now when will it be ROR, RNOR? So two additional conditions which we discussed will have to be fulfilled by Karta. Karta fulfills both the additional conditions. If Karta of the HUF fulfills both the additional conditions, and both the additional conditions, if you recollect, require us to have some past data, require us to go backwards. The first additional condition requires us to have the data of last 10 years and the second additional condition requires us to have the data of last 7 preceding previous years. If Karta fulfills both the additional conditions, then HUF will be ROR. Otherwise, HUF will be RNOR. Karta does not fulfill either of the two additional conditions or one of the additional condition, then HUF will be RNOR. Okay. Now control management should be de facto control, that is okay, and control management are said to be situated at that place where head, seat and the directing power are situated. This is unimportant. First point is slightly important. Okay. Now the next is section 6.1 is for individual, 6.2 is for HUF, partnership firm, LLP, AOP. 6.3 is for company. For company we will discuss in some time. I am jumping to 6.4. 6.4 section 6 clause 4 is for all other persons other than individual HUF, AOP, partnership firm, LLP and company, other than company also, though we have yet to discuss for company. Here also everything depends upon location and control of management and affairs. Exactly same as section 6.4 is exactly same as 6.2, but it is given separately for all other people depending on the place of location of management and control. Three possibilities: management control is wholly in India, wholly outside India. Third possibility, partly in India, partly outside India. What to do? If the management is wholly outside India, then non-resident, partly in India, partly outside India, then resident, and wholly in India, then definitely resident. Same as whatever we discuss for HUF, partnership firm, LLP. Exactly same concept applies here also. So from exam perspective, just remember only one situation, this situation. Remaining two are fill in the blanks. Okay, now residential status of company. As far as companies are concerned, the rules were drastically changed by new government with effect from AY 1617. AY 1617, it's been 9 years now, about to be 10 years. So here companies are divided into two categories, Indian company and foreign company. First of all, company can be just like partnership firm and LLP, company can be resident or non-resident. It can never be ROR or RNOR, only resident, non-resident. Okay, Indian company is always resident in India. Indian company means company which is incorporated in India under Companies Act 2013 or maybe under earlier act, Companies Act 1956. But company can be resident, non-resident, but that is only for foreign company. Indian company is always resident in India. Now AY 1617 onwards, we have to discuss the concept of place of effective management. Place of effective management is different than the concept which we applied for HUF and partnership firm and LLP. For HUF, partnership firm, LLP and AOP, the concept was place of control, location of control and management, or you can say place of control and management. Now place of control management is different, or you can say that is place of management. Place of management is different and place of effective management is different. Here there is one extra word, effective, abbreviated as POEM, poem. Some people pronounce it as poem also. Now place of management could be three possibilities, could be wholly in India, wholly outside India, or could be partly in India, partly outside India. But as far as place of effective management is concerned, there cannot be the third possibility. It cannot be partly in India, partly outside India. Either it is in India or it is outside India during the year. Remember, Indian company is always resident, come what may be. It is only foreign company for which we have to decide the residential status. Foreign company, if the management, that is place of effective management, is in India, then it is resident in India. Otherwise, it will be non-resident. If the management, that is effective management, is outside India during the year, there cannot be possibility of partly in India, partly outside India. Then it will be non-resident. This is something which you need to remember. At CA final stage, institute will ask you question only on companies rather than asking you question on individuals or HUF or some other people. Individuals are relevant with regards to category 1, 2, 3, 3 exceptions. Okay. So, Indian company always resident, that you need to remember. Now, before we finish this residential status part, there is some small point with regards to crew members of ship, which is governed by Rule 126. So, I am taking you to Rule 126, which I have covered separately in a separate note. In the classroom also I covered it separately, but it is a part of this chapter only. Rule 126 talks about crew members of the ship. Crew member means staff members. So, supposingly this is India. So, supposingly this is India, and as we know, India includes not only India, India includes territorial waters of India also. Outside the border of India, there is something called up to 12 nautical miles, as shown in this slide. Okay, up to 12 nautical miles, it is called territorial waters of India, which is also considered to be part of India. Then what happens is, supposingly there is a ship coming near to the seashore. Ship keeps coming in, coming in, coming in. Ship finally reaches the Indian territorial water. It is half inside, half outside, or supposingly ship has already entered the Indian territorial waters. Ship is in the middle of the water, but has not yet got permission from customs, has not got customs clearance, so has not been able to reach to the seashore for any reason. It is still standing in the middle of the water. For 3 to 4 days, it is still in the middle of the water, and even after reaching the seashore or the seaport, after reaching there, the staff members have to sit inside only for maybe next 2-3 days, 4-5 days. When the ship is offloaded, goods and passengers are offloaded, new goods are loaded, refueling is done, cleaning work is done. All these formality till the time 3 to 4 days they are still inside the ship. Then what to do? Whether for those 3-4 days, whether they will be deemed to be inside India or not. So, we are not talking about passengers of the ship, we are talking only about the crew member, remember that. So, when the ship has entered Indian territorial waters, the tick 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 starts. The number of days present in India, countdown begins. But they are in India for 4 days, ship is inside the Indian territorial waters for 4 days. Whether those 4 days the crew member will be deemed to be present in India or not, the answer is no. They will not be deemed to be present in India. They will be deemed to be present in India. Their presence starts from the 5th day, the moment they come out of the ship. Why is it like this? So, I will tell you why. Because of Rule 126. Rule 126 says that for an individual who is citizen of India, remember this benefit is only for citizen of India, as a member of the crew of a ship, whether Indian ship or a foreign ship, as a member of the crew of the ship, his period or periods of stay in India shall not include the period computed as per sub rule 2. So, the way in any school or coaching class or college, we have something called attendance register. Even when you take up a job also, there will be attendance register where your attendance will be marked either biographically, in the sense you put your fingerprints or you sign the register. Same way these people also have their attendance register or payroll register, which is called continuous discharge certificate, CDC. It's a technical word associated with the shipping industry, continuous discharge certificate. So, what happens is, the moment ship reaches to Indian border, captain of the ship and the staff members are still inside the ship. They will be deemed to have entered India only when they sign this CDC and come out of the ship. Then only they will be deemed to have entered Indian market. They will be deemed to have entered Indian soil. So the period to be excluded shall not include the following period given in subrule 2. So which period is to be excluded? The answer, when they are leaving from India, the moment they enter the ship, they will sign CDC. The moment they sign CDC, while entering the ship, they will be deemed to be out of India. Even though ship is standing there for 4 days, they will be deemed to have left India. Same way, when the ship arrives back to Indian port, members are still inside the ship, but they will not be deemed to be, they are already inside the Indian territorial water, crew members, but they will not be deemed to be inside the India unless and until they sign the CDC and come out of the ship. So period beginning on the date entered into in the continuous discharge certificate, that is CDC, in respect of joining the ship. In respect of joining the ship, the moment they enter the ship and sign CDC, they will be deemed to have left India. The period starting with the date of entry in the CDC and ending on the date of again signing date entered into in the CDC in respect of signing off by that individual from the ship. As the moment ship comes back after completing the journey, after 1 month, 2 months or whatever, then crew members are still inside the ship. 4th day, 5th day when they come out of the ship, at that time they will sign CDC. So supposingly the ship starts journey from India from 1st January 2025 and the ship returns back to India on 18th February 2025. 18th February. However, as far as crew members are concerned, crew members enter the ship, passengers, the journey started on 5th January 2025, the journey started, and the ship arrived back to India on 18 February 2025, but the crew members came out of the ship on 23rd February 2025. So in such situation, crew members will be deemed to have left India on 1st January 2025, the date entered into in the CDC. The moment they enter the ship, they will sign on 1st January, they would be deemed to have left India. And then the crew members will be deemed to have come back to India on 23rd February 2025. 23rd February 2025. That means they were not in India for these 5 days, though the ship has already come, and they will not be deemed to be in India for these 4 days. So first 4 days and last ending 5 days, 9 days they are out of India. Are you following this? Okay. Questions have not yet come on rule 126. And what is continuous discharge certificate? That is clarified. That clarification is totally unimportant. Now coming back to this chapter. Now we are done with section 6 entirely except of place of effective management for companies, that too foreign companies. Now section 5, scope of total income. Somewhere while discussing section 9, we had discussed that the taxability of an income depends upon, or rather I would put my question differently, whether an income will be taxable in India or not. Taxability in India depends upon 3 factors. Number 1, what is the place of accrual? If the income is accrued in India, accrual of income will include deemed accrual also, and arising of income or deemed arising of income, or place of receipt. If it is received in India, or the person earning the income is resident of India. Person is resident of India. These are the 3 factors which will decide the taxability. So even while discussing chapter 12, special rates of tax, I had explained it to you. Recently Coldplay, that band had come, or the troupe had come. They performed in India at Mumbai, Ahmedabad, couple of places. Whatever they earn from India, whether that income will be taxable for them in India or not. So they are not resident in India, Coldplay people, but they have received income in India and the income is accrued in India. Therefore they will be liable to pay tax. Same way, if I go abroad, my income is not accruing in India, my income is accruing outside India, received also outside India, but I am resident of India, therefore I will also be taxed in India. So the taxability of any income depends upon 3 factors. Ideally, these 2 factors are combined together, generally understood as one and the same. The place where this is called popularly as source of income. Source of income is in India, that means either income is received in India or income is accrued or deemed to have accrued in India. Actual accrual is understood, deemed accrual is governed by section 9. So we have to merge 2-3 sections, section 6 And for accrual of income, we have to take into account section 5 and section 9 to decide whether income is accruing or deemed to be accruing in India or not. Any of the three is in India, then the taxation point gets triggered. The situs of taxation begins. Okay, so now income can be Indian income or can be foreign income. If it is Indian income, no friends, then it is taxable for all of them. Whether the person is RoR, RNOR or NR, it will be taxable, taxable, taxable. Indian income is always taxable in India because it is accrued in India or arisen in India. What do you mean by Indian income? So Indian income means Indian income, whether given income is Indian income or foreign income, that will depend upon place of receipt and place of accrual. It's accruing or deemed to be accruing, or arising or deemed to be arising in India, or received or deemed to be received in India. Based on that, we will decide whether given income is Indian income or a foreign income. If income is accruing, arising also in India, and income is received also in India, for example my income, then it is definitely an Indian income. Then it depends upon my residential status also, but that we will discuss later. Residential status we are done with. RoR, RNOR, NR, three possibility. The taxability will depend upon residential status as well as the type of income. So as far as type of income is concerned, how to decide Indian or foreign? So that depends upon factors like place of accrual or deemed accrual, or place of receipt or deemed receipt. If the income is earned outside India, for example, I go to Dubai, JK Shah classes people send me to Dubai, I earn some income in Dubai. So place of accrual is outside India. But they did not pay me in Dubai. JK Shah classes people told me that, sir, after finishing the batch at Dubai, whenever you come back to India, and that time we will make you payment in India next month whenever you come back. I said, okay, no problem. Again Indian income. Why? Because place of receipt is in India, though the place of accrual is outside India. However, they told me to take lectures outside India in that case, but payment was to be made in India. Now opposite situation. Supposingly I take lectures in India, and supposingly now I am retiring and I am shifting to Canada permanently. So I told JK Shah classes people that for this month give me payment by the end of this month only, otherwise next month I will not be there in India. I am closing down my all bank accounts. It will not be possible for me to receive the payment in India. I am closing down all my bank accounts and I am shifting to Canada permanently. So please clear off the payment by the end of this month. They said, no, not possible. As per our policy, we will pay you next month only, come what may be. We can't change policy for one person. I said, well, next month I will be out of India. They said, okay, don't worry, we will pay you. We will pay you directly through wire transfer. We will credit it to your Canadian account. You give us the details of Canadian bank account, we will transfer it there. So I took lectures in India, but the payment is received by me outside India. Place of receipt is outside India. Then also it will be, oh, I connected with the wrong point. It should be this. Outside India, still it will be an Indian income because lectures are taken in India. But both the things are outside India, then only it can be called as a foreign income. So in order to be called as foreign income, I am sure by now you must have understood that it can be called as a foreign income only if both the things are outside India. Which two things? Place of accrual, including deemed place of accrual, or place of receipt, including deemed place of receipt. Accrual, receipt, both the places should be outside India, then it will be foreign income. Right? The only one possibility of income becoming foreign income is this. Okay. Now as far as place of receipt is concerned, we have to consider only the first place of receipt. Second place of receipt not to be taken into account. For example, any of your relative is staying abroad and earning income. Say your relative is staying at Dubai, he earns income there. The income is earned in Dubai, accruing in Dubai, UAE, received also in UAE. Then that person remits that amount back to India to his family members. Then in that case, India becomes a second place of receipt. Income is received in Dubai also, income is received in India also. Two places, but we have to consider only the first place of receipt, that is India. Second place of receipt not to be checked. Clear? Okay. Now once decided which income is Indian income, which income is foreign income, then the next point is scope of total income. So Indian income is always taxable for all three, irrespective of residential status, right? That we have understood. The table which we have studied a long back at Inter CA, triple T, double T, single T, that table. Now as far as foreign income is concerned, we divide them into two categories. Number one, foreign income from business control from India or from a profession set up in India. Business control from India or a profession set up in India, though it is a foreign income, it is kind of treated at par with Indian income. Though it is foreign income, how it is foreign income from business control from India? It is foreign income because it is accruing also outside India, it is received also outside India. So practically it's a foreign income. But in spite of being a foreign income, it will be considered as kind of Indian income if it is from business which is controlled from India, or it is from a profession set up in India. What do you mean by profession set up in India? So let's talk about you. You became chartered accountant, you started practicing. Once you started practicing, you got a call, you got some assignment from somebody located in UK that you please come to UK, stay here for 1 week, we will pay you 50 lakh rupees of fees, but you come to UK and provide your services here regarding some financial issue, not regarding audit or taxation which is restricted to Indian market. You went to UK for some accounting treatment work and you successfully, they were very happy with you, so they paid you 50 lakh rupees. So where is it accruing? It is accruing in UK because you rendered your services in UK. Where is it received? So answer, received also in UK. You had a bank account in UK, so you deposit. But it is from your profession which is set up in India. You got this income because of your profession of chartered accountancy. Where did you do your CA course? India. Where is your COP registered certificate of practice? India. So it's an Indian income. Being an Indian income, technically it's a foreign income, but a special foreign income. We will not call it as Indian income, but it's a special foreign income. Then for non-resident it is not taxable. For ROR it is certainly taxable. See, ROR will be taxed for each and every income. Once you are resident in India, and that too ordinarily resident, your global income will be taxable, right? Okay. Now as far as RNOR is concerned, this kind of income will become taxable. So this you need to keep it in your mind. But if it is any other foreign income other than from business control from India or a profession set up in India, then it will be taxable only if you are ROR. Not taxable if you are RNOR or non-resident. Meaning thereby, if you observe it carefully, then you will realize one fact that person, two things you need to observe, but I will tell you three things. Which three things? Understand. First, if you are ROR, person whose ROR will be taxed for his global income, whether it is Indian income or a special foreign income from business control from India or a profession set up in India or any other kind of normal foreign income. ROR will be taxed for his global income. And second thing to be observed is that the Indian income is always taxable for everyone irrespective of the residential status. ROR, RNOR, NR, everyone, Indian income will always be taxable, come what may be. That's one thing. Second thing I would like to, that these are the two things. Third thing which not everyone may understand, please try if you can. The third thing is that if you recollect, Nirmala Sitharamanji from AY 21-22 onwards, she introduced this category 2 and category 3. Category 2 and category 3, two types of exceptions. I repeat once again, the word category 2 and category 3 is not used by government. These two terminologies or the word category is used by me for the sake of simplicity in our understanding. Okay, not from exam perspective. Exam perspective, this is called explanation 1 clause B to section 6(1), and this is called as section 6 clause 1A. So category 2 and 3 were newly introduced by Nirmala Sitharamanji from AY 21-22 onwards. Now prior to that, as per from AY 21-22 onwards, category 2 and 3 people, both of them will be deemed to be RNOR. Both of them will be deemed to be RNOR, right? If Indian income is more than 15 lakh, we saw. So earlier they were supposed to be non-resident. Now because of this amendment from AY 21-22, they both will become RNOR instead of remaining NR. That is the magic. So how it will be impacting if a person who is non-resident till last year becomes RNOR, then what exactly will happen? So answer, that's what we need to understand. Person who is NR now becomes RNOR. So which all incomes are there? Which all incomes are there which would not have been taxable had the person been non-resident, but now becomes taxable because he is RNOR. So there is only one income, that is income from business control from India or income from profession set up in India. Only this income was not going to be taxable had he been non-resident, but becomes taxable because he becomes RNOR. Otherwise, other foreign incomes are not taxable for RNOR also and not taxable for NR also. And Indian income, you know, everyone it is taxable for, whether the person is NR or is RNOR. Indian income is always taxable for everyone, right? So this is the loophole, this is the place where it will make a difference. So Nirmala Sitharamanji wanted to capture these people. Clear till here? Okay, now, so technically residential status concept is over except of place of effective management, which we will be discussing in a separate video. So for that, please log into that video, have a look at it, search for it, you will find it, it is after this video. Section 163, agent of non-resident. Now agent of non-resident, there can be two types of agents. First of all, non-residents are not present in India. So in order to serve notice to them, or in order to serve any assessment order, reassessment order, there should be some Indian address available. Somebody should be there in India representing non-resident. So non-residents are supposed to appoint somebody as their agent in writing on a 500 rupee stamp paper. That person will be called as specifically appointed agent. Specifically, generally non-residents appoint their chartered accountants or lawyers to be their agent. However, by chance, due to unaware of this provision, if non-resident does not appoint anybody, then somebody can be deemed to be the agent of non-resident. Deemed to be means assumed to be. So in this section 163, we are going to talk about both the types of agents, but primary focus is on deemed agent, who can be deemed to be the agent of non-resident. Deemed agent concept comes up in the picture only when non-resident had not appointed somebody to be their agent. 5 types of people can be deemed to be the agent, and there are some 2-3 points to be noted. One by one we will be discussing. Number 1, person who is an employee of non-resident, but employee where? In India. Employee in India, or a person employee in India, or a person with whom non-resident has any business connection. Person who has business connection in India with non-resident. Supposing some non-resident comes to India for few days and he contacts me that he wants to invest some 100 crore rupees. So I said, yes, don't worry, I will take care of everything, I am very good in that. So I entered into some contract, joint venture contract with that non-resident. So non-resident, he gave me 100 crore and he trusted me. He said, you invest wherever you want to, profit we will share 50-50. So in such situation, I will be deemed to be the person having business connection with non-resident. If non-resident had forgotten to appoint somebody in writing, then department will look at me. They will try to treat me or assume me to be the agent of that non-resident. Third is the person from whom the non-resident is in receipt of any income. Non-resident is in receipt of any income in India. Meaning thereby any person who makes payment to non-resident, say the organizers of this cold play, they must have made payment, or they were responsible to make payment to these people, or any IPL match if you talk, then any IPL team is required to make payment to foreign cricket players. If that foreign national cricket player forgot to appoint somebody to be his agent in writing in India, then that IPL team itself will be deemed to be the agent. They will be responsible for any tax, interest, penalty, etc. on the part of non-resident. Same way, person who is a trustee of the assets of non-resident in India. Person who is a trustee of assets in India. Trustee as in caretaker. Caretaker of non-resident's assets. Somebody says Sunny Leone becomes non-resident in India. Of course, she has become resident. I agree with you. But by chance, if she was still a non-resident and she appoints you to be her agent to look after her assets in India, to take care of that, and you will be compensated with some particular amount every year, then in such situation you will be deemed to be, or you can be deemed to be the agent of Sunny Leone, the non-resident, if she is still a non-resident. Fifth and the last, person who has acquired property, capital asset, person who has acquired capital asset in India from a non-resident by way of transfer. So here, this is a very dangerous point. You know what happens is, I always advise my clients that whenever you deal with any non-resident, whenever you buy any property from non-resident, you will have to be very careful. If this non-resident, he will run away. After receiving, say you bought a flat worth 5 crore from non-resident, you will pay him 5 crore, he will go away. After TDS, you paid him 5 crore. He will go away. Property is transferred to you. But afterwards, if any proceeding is taken up in relation to any earlier year and any liability arises and the non-resident has already left country without appointing anybody as agent in writing, then you can be deemed to be the agent. This can create problem for you. Okay, and this has happened with many people. So generally what we advise clients is that to not to make full payment to non-residents, keep something pending for 1 or 2 years, or deposit that amount in some escrow account, escrow bank account, and then that amount can be released to non-resident after satisfaction of certain conditions. 2 points to be noted: no person can be deemed to be the agent of non-resident unless show cause notice is issued by AO to him, giving him an opportunity of being heard, asking him to show a cause as to why should he not be deemed to be the agent of a particular non-resident. Show cause notice. For example, tomorrow JK Shah classes, the main person JK Shah sir, he becomes non-resident, and just because I have some business connection, because I am working here, if I receive any notice, show cause notice, asking me to clarify as to why I should not be deemed to be the agent, then I can respond back that sir, I have no access to books of accounts or bank account of JK Shah classes, I should not be deemed to be the agent, maybe some other person but not me. And last point, or the second point, if agent deemed or specifically appointed agent, agent makes payment on behalf of non-resident to income tax department, then under income tax act, for anything, tax, interest, penalty, fees, anything, then agent will have a right to recover the same from the non-resident whenever non-resident comes to India, or in case if the agent is in custody, agent has a custody of any asset or bank account balance or cash balance belonging to non-resident, then agent will be authorized to retain that asset with him or retain that money with him on behalf of non-resident. Then we have this first proviso to section 48(1). Residential status is over, scope of total income is over. Now we started discussing other points. One was section 163. Second one is first proviso to section 48, which is a part of capital gain chapter. We already finished discussing it in capital gain chapter, but we'll repeat once again. This is applicable only in case of non-resident or a foreign company who have acquired shares or debentures, only two assets, while calculating capital gain on shares and debentures of Indian company in the hands of non-resident. Everything, sale consideration, transfer expense, that is net sale consideration, cost of acquisition, everything which is available in Indian rupees, from Indian rupees convert everything into foreign currency and calculate capital gain in foreign currency, and the balance amount, that is capital gain, which is so computed in foreign currency, reconverted back into Indian currency. Translate everything from Indian currency to foreign currency. Which all items? Sale consideration, transfer expense, cost of acquisition, cost of improvement, everything convert from Indian rupees to foreign currency, calculate capital gain in foreign currency, and then final answer of capital gain reconverted back into Indian currency, but only for non-residents and only for shares and debentures of Indian company which are acquired in foreign currency. Four conditions are fulfilled, then only first proviso to section 48 is applicable. Second proviso to section 48(1) is indexation. First proviso is this. Okay, first proviso we have discussed in NRI taxation chapter also briefly, we have discussed it in capital gain chapter also. So here sale consideration, transfer expense, cost of acquisition, three items from Indian currency converted into foreign currency, final capital gain reconvert back into Indian currency without availing indexation benefit. Indexation is no more available to anybody otherwise also, but indexation when was available, that time it was to be ignored. Which currency conversion rate to be applied? So answer, telegraphic transfer rate of State Bank of India, SBI rate, as per rule 115A. Let's try to understand. Supposingly sale consideration, everything in terms of Indian rupees is 1 crore 29 lakh 60,000, transfer expenses are 8 lakh 10,000, and net sale consideration will be 1 crore 21 lakh 50,000, cost of acquisition is 42 lakh. So capital gain, long term or short term, capital gain is 79 lakh 50,000. You can calculate it and confirm it in your calculator. Okay, now what to do? So in terms of Indian rupee, capital gain works out to be, taxable capital gain works out to be 79 lakh 50,000. This is to be ignored. Convert everything from Indian currency to foreign currency and calculate capital gain in terms of foreign currency. Which rate to be applied? So answer, for sale consideration apply average rate. We have three rates: buying rate, selling rate and average rate. So you here apply average rate. Average rate as on which day? Average rate two dates: date of acquisition, date of transfer. Average rate as on date of transfer. as on the date of transfer. Same thing for transfer expense also. Apply, convert from Indian rupees to foreign currency, applying average rate as on the date of transfer. So net sale consideration is automatically converted. Then you convert cost of acquisition from Indian currency to foreign currency, applying again average rate, but this time it will be average rate as on the date of acquisition. And not as on the date of transfer. Final capital gain which you will get will be in terms of foreign currency. Which foreign currency? Answer, that original foreign currency which was brought into India for the purpose of making investment, that you reconvert into Indian rupees, by applying. Now this time, every time we ended up applying average rate, this time you apply telegraphic transfer buying rate of State Bank of India. As on what day? Buying rate instead of average rate. Buying rate of State Bank of India as on which date? As on the date of transfer, the date on which asset is transferred. So suppose any three rates are given to you. One is 82, buying rate, selling rate and average rate. 82 is one of them, 80 is one of them, 81 is automatically average rate. 82 plus 80 divided by 2, average rate will be 81. Okay, understood. But out of these two rates, which one is buying rate, which one is selling rate? So understand, whether it is buying rate or selling rate, the terminology which is used, buying rate, selling rate, is always from the perspective of, always from the point of view of the dealer. From dealer perspective, this is the selling rate 82 and 80 is the buying rate, meaning thereby seller, the dealer, authorized dealer under FEMA, he sells at 82. This is the selling rate from his point of view. For you as a customer, this becomes buying rate. Opposite language will be used. So he sells it for 82, you want to buy, you will have to pay 82. He buys it for 80 rupees, that is the buying rate from dealer's point of view. You want to buy, you pay 82. His buying rate becomes your selling rate. So that is how they earn the difference between the two, which is 2 rupee, which is also popularly called as spread. So idea is that if you want to buy, you just bought 2 minutes back only, you bought at 82 rupees. Then you realize that you bought excess currency, you returned back $1000, then dealer will take it back at 80 rupees. You will suffer a loss of 2 rupee per dollar. That is the difference, that is their profit margin, that is their spread. Okay, so apply 1 crore 29 lakh $60,000, Indian rupees, sorry, not dollars. Convert it into dollars, applying average rate as on the date of transfer. Average rate as on the date of transfer is this, 81 rupees. 81. So 1 crore 29 lakh 60,000 Indian rupees divided by 81 Indian rupees, that will give you $1,60,000. Then transfer expenses 8 lakh 10,000. This also you convert, applying average rate, which is 81 rupee as on the date of transfer, which will tend to amount to $10,000. Balance will be 1,50,000 US dollar. This is automatically derived amount. Some of you might feel that, sir, why don't we straight away convert this only? Answer, that is a shortcut way, but in rule 115A they have given the long cut way, so you also better follow a long cut way in the exam, right? Okay. Now cost of acquisition 42 lakh in terms of Indian rupees, converted into foreign currency by applying average rate as on the date of acquisition instead of date of transfer. There is a difference, be careful about it, which was 42 rupee. At 42 rupee it will be $1 lakh. $1 lakh. Difference is 50,000 is a capital gain, $50,000. What you do with this? This you convert or reconvert from dollars to Indian rupees, applying, this time you will apply telegraphic transfer buying rate. At the end you apply buying rate, which is 80 rupees. 80 rupees, your gain will be 40 lakhs only rupees 40 lakhs, as compared to almost double 79 lakh 50,000 in terms of Indian rupees. In terms of, if you would have calculated in the absence of this first proviso to section 48, in case you would not have applied this proviso, or maybe your client was not aware of it, he would have calculated in terms of Indian rupee, and that capital gain would have been almost double of the capital gain which will now arise. Remember, this concept is applicable not only for long term, it is applicable for short term also. For long term also, short term also calculating, but is available only for non-residents and foreign company, not available to other people. Then the next is section 115A, 115AB, AC, ACA, AD, BBA. These are the sections which we discuss in chapter 12. Chapter 12 was special rates of tax chapter. Special rates of tax chapter we spent lot of time discussing with it. Here there were some around 17-18 incomes were given which were to be computed by applying 4 glasses of restriction. 4 restriction of 4 glasses of bitter gourd juice. If you recollect, which 4 bitter gourd juices, which 4 restrictions. Answer: while computing income covered by these sections, incomes covered by these sections, it shall be computed without claiming deduction of any actual expenditure incurred to earn the income, without chapter 6A deduction, without basic exemption limit, and without indexation benefit. Indexation is not a great benefit. Indexation is no more allowable now onwards to anybody. Forget about non-resident. It is not allowed to even residents. But as per this first proviso to section 48 was there since ages. As per first proviso, indexation not allowed because assessee is non-resident or a foreign company. Indexation not allowed to these people, that is a fourth restriction. Then we discussed chapter 12A, section 115C till section 115I, C, D, E, F, G, H, I, 7 sections. Here again the same principle, income to be computed at gross level without chapter 6A, without actual expenditure, without chapter 6A, without basic exemption, without indexation benefit. We have practical questions coming from this NRI taxation, which is covered by chapter 12A. Then we have section 1990A that we are already done with. DTAA provisions. DTAA provisions are applicable only when income is taxed or is liable to be taxed in both the countries. Then transfer pricing chapter we discussed the meaning of the term we discussed the meaning of the term permanent establishment, PE. Permanent establishment we repeated in some other chapter also. But permanent establishment is ideally it means branch, factory, shop, showroom, godown, warehouse, etc. a fixed place of business. Along with DTAA provision, permanent establishment in India is defined in section 92F clause 3A, which means fixed place of business. Fixed place of business in India through which business or profession is wholly or partly carried on. Then the next is very interesting concept, presumptive taxation scheme. The way we have presumptive taxation scheme for residents governed by 44 AD, whereby income for businessman will be either 6% of turnover for that much turnover which is achieved by way of banking channel, otherwise 8% of turnover in case if turnover is achieved in cash. Same way we had 44 ADA for professional people, income will be deemed to be 50% of professional gross receipt. Same way we had 44 AE also, transporter. Now the way we had 3 sections for residents, same way we had 4 sections for non-resident, which we had briefly discussed in PGBP chapter also, minimum alternate tax chapter also. PGBP I would not say briefly, in PGBP chapter we had discussed it in detail. 44B, 44BB 5 section, 44 BBA and 44 BBB. Here income would be deemed to be 7.5%, presumptive taxation, no? So income would be deemed to be 7.5% of gross receipts attributable to Indian operation. 44 BB 10%, 44 BBA airline operation, aircraft operation of aircraft 5% of gross receipts attributable to Indian operations, and 44 BBB again 10%. And wherever it was 10%, assessee had an option to disclose actual income. Option to disclose instead of presumptive income, option to disclose actual income if some parameters are satisfied, like they have to maintain books of accounts compulsorily and get that books of accounts specially audited. Even if audit is not attracted, they will have to get the books of accounts audited. Wherever it is 10% no, there this option is available. Wherever 5% or 7.5% is applicable, there assessee like 44B and 44 BBA, assessee cannot opt for presumptive taxation scheme. Presumptive taxation scheme is automatically applicable. Within presumptive taxation scheme, assessee cannot disclose actual income. For these 2 sections, assessee can go for actual income by maintaining books and getting them audited. So presumptive taxation scheme, one section newly introduced, which is important because newly introduced, this is for cruise ship. business of operating cruise ship, whereby income will be 20% of gross receipts attributable to Indian operations. 20% of gross receipts attributable to Indian operations. What do you mean by gross receipts attributable to Indian operations? That is also clarified, which we will be discussing. Concept applies to non-residents and foreign companies, does not apply to V residents. Very first section is 44 single B, income from operating ships. But because of newly introduced 44 BBC, which is for operating cruise ship, therefore they said other than cruise ship, income will be deemed to be 7.5% of gross receipts attributable to Indian operations. Remember, it is not tax rate. This is not special rates of tax chapter. It is a part of PGBP chapter, which just talks about how to compute income. So income don't calculate whatever is the gross receipt into 7.5% matter over. 44 double B, where assessee can maintain books, get them audited and disclose actual income. Here presumed income will be 10% of gross receipts attributable to Indian operations. Income from which business? Business of supplying plant machinery on hire. Income from business of supplying plant machinery on hire for prospecting for extraction of or production of minerals. Prospecting for means searching for, extraction means once found out they have to dig deeper into the ground, and the officers will, with the help of machinery, will do lot of digging around 2-3 kilometers underground, and they will extract whatever possible, mainly mineral oil. 44 BBA, business of operating aircraft. Here income would be deemed to be 5% of gross receipts attributable to Indian operations. And this is institute's favorite, 44 BBA. But now question can be asked on 44 BBC also. 44 triple B only for foreign companies. This section is only for foreign company, not for other non-residents. Reason not difficult to understand. Very simple reason that this kind of activity, what we are going to discuss here, can be done only by a company, cannot be done by individuals, HUF, partnership firm, ideally not possible. Three types of income: income from the business of civil construction, erection of plant machinery, testing, commissioning. Commissioning means starting, means they will keep it ready to use, of plant machinery in connection with the turnkey power project approved by central government. Turnkey means single person doing everything. Single person does everything. He only will construct the building, he only will arrange for plant machinery, he will do everything. That person, okay, then when a single person does everything, then that is called turnkey power project. Could be nuclear power project, could be hydropower project, could be solar power project, any kind of project. Project is handed over to some foreign company. Only for foreign company, income will be deemed to be 10% of gross receipts attributable to Indian operation. And last but not the least, very important, income from the business of operating cruise ships. AY 25-20, cruise ships income will be 20% of gross receipts attributable to Indian operations, gross receipt from cruise business. Now what is cruise, you know pretty well. Cruise ship is something luxurious ship like Titanic, that kind of a thing, which is newly introduced here with a higher percentage, because it's a luxurious thing as compared to the ship which is covered by section 44B, which is a basic level ship. Now everywhere we had been talking about 7.5% of gross receipts attributable to Indian operations, 10% of gross receipts attributable to Indian operations. The question is, when can we say that the given gross receipt is attributable to Indian operations? So for section 44B BBA, that is ship, aircraft, and 44 BBC cruise ship, when can we say that income is accruing or gross receipts are attributable to Indian operation? So answer, that depends upon the place of receipt of the fare, place of receipt, and the place of origination of the journey. From which country is the journey originating? So place of receipt, and the second is place of carriage of goods, passengers, mail or livestock. If either of these two, either the place of receipt or the place of beginning of journey, either of them is from India or in India, then it will be considered as gross receipt attributable to Indian operations. Otherwise it is not attributable to Indian operation, and this is the most important table, you will have to remember it properly. Supposedly the place of receipt is in India, traveling, the beginning of journey is also from India. Supposedly I travel to USA through, let's say, Cathay Pacific. So where is Cathay Pacific receiving money from me? So answer, they are receiving it in India. Place of receipt is in India because I booked tickets from India. And where am I beginning my journey? Answer, my journey also begins from India only. Then it is definitely attributable to Indian operation. Yes. Second, in case if the place of receipt is outside India, I generally give example of my uncle. My uncle stays at Japan. He keeps on calling me, come to Nihit, come to Japan, come to Japan. I always keep on saying, no uncle, oh, I don't have time, I don't have time. But money problem, I don't have money to buy the tickets. In India to Japan, tickets are very expensive, especially return ticket. So my uncle realized it, and my uncle said, I will make payment to Cathay Pacific. I will book the tickets for you sitting in Japan. You just come to India. I said, okay, fine, this is fine. Now I have lot of time. So Cathay Pacific people received money from my uncle outside India. Place of receipt is outside India. But the journey begins from India. I traveled from India to Japan. Then in that case, it is still attributable to Indian operations. Suppose my son, suppose I am very rich person, my son stays in USA and I am in India, and due to some emergency situation I had to call up my son and I told him that something emergency, you come back to India instantly, book the tickets, come to India. My son replied, Papa, I have time, I can manage, but my exams are over, but I don't have money to book the tickets. I said, beta, don't worry, money is my problem. I book the tickets from India, let's say British Airways. British Airways people receive money from me in India. Money is received by British Airways from me in India, but the journey of my son begins from USA, outside India. Then also it is income or gross receipt attributable to Indian operation. And in case both the things are outside India, then it is not deemed to be attributable to Indian operations. So only possibility of not being attributable to Indian operation is both the things are outside India. Place of receipt is also outside India, and the place of origination of journey, beginning of journey is also outside India. Okay, this is applicable for 44B, double BA and 44 BBC. Ship, normal ship other than cruise, airlines, and 44 BBC, that is for cruise ship, luxury ship. Okay, so that was in a tabular form. Now in legal language, in a technical way, what exactly they have mentioned, 44B and 44 BBC. For these two sections, it shall be 7.5% or 20% or 20% of following, aggregate of the following. 1, 2, 3. First one says amount received, whether in India or outside India. So here place of receipt is immaterial. In this point, place of receipt is immaterial. It says if the goods, passenger, mail, livestock are shipped at any port from India, shipped at any port in India. Now shipped at any port in India means the journey begins from India. Place of receipt, any place whether in India or outside India, but the origination of journey is from any port in India. Second possibility, journey is from anywhere, place of receipt is in India. Shipped at any port outside India, shipped at any port outside India, but the money is received in India. Received, receivable, deemed to be received in India. Third, demurrage charges and handling charges. Demurrage charges means loading, unloading charges, etc. Those charges, extra charges are called as incidental charges, are called as demurrage charges. If received in India, they will be deemed to be gross receipts attributable to Indian operation. Demurrage charges are also to be taken into account. And 44 double B, what is 44 double B? 44 double B is for providing services or facilities or supplying plant machinery on hire for three things: prospecting for extraction of or production of mineral oil. Mineral oil will include petroleum and natural gas also. Crude oil, natural gas, both. That is mineral oil. Prospecting for means searching for. Once it is searched, then extracting it. After extracting it, taking it to the factory and through chemical process or through other processes, converting it into a proper finished good, that is called, or refining it is called as production. So here what should be in India? The answer here, place of receipt should be in India, or ultimately irrespective of the place of receipt, the activity which we talked about here, that should be in India. Either prospecting of mineral oil should be in India, or extraction of mineral oil should be in India, or production of mineral oil should be in India. Place of receipt is immaterial, whether received in India or outside India, that is immaterial. Here place of receipt is also immaterial. What should be in India? Answer, either extraction, prospecting for extraction of or production of mineral oil should be in India. And 44 triple B with regards to turnkey power project, here since we already discussed these three sections in all these 5 sections in PGBP chapter, I am going little faster. 10% of amount attributable to or gross receipts attributable to Indian operations. But when can we say that it is attributable to Indian operation? Then the civil construction, erection or testing, commissioning of plant machinery, that should be in India, irrespective of place of receive. Received, receivable in India or outside India, what should be in India? Civil construction or testing, commissioning or erection of plant machinery should be in India. Okay. Now out of these 5 sections, for 2 of them an option is available to declare actual income by maintaining books of accounts and getting them audited. 44 double B and 44 triple B. Wherever the income percentage is 10% out of these 5 sections, one is 44 double B and one is 44 triple B. If 2 conditions are satisfied, then they can declare actual income if actual income is less than 10% of gross receipts attributable to Indian operation. Maintain books of accounts and get them audited and declare actual income. AY 24-25, one clarification was inserted for these 2 sections, 44 double B and triple B, these 2 sections, wherever the rate is 10% and where actual income can be declared by fulfilling these 2 conditions. There government says while computing these 2 incomes, no deduction will be allowed or no set off will be allowed for brought forward business loss or brought forward unabsorbed depreciation under section 32 subsection 2. These 2 will be deemed to have already been allowed. So in the 10% of the gross receipt, 90% is assumed to be expenditure and 10% is assumed to be income. In that 90%, all these things are already covered up. Okay, now 44C, head office expenditure. If head office is outside India and the branch is in India, head office outside India, branch is in India, then branch remitting to head office, the expenditure which is attributed by head office to India, some part will be allowed, some part will be disallowed. How much will be allowed? Lower of the 2 will be allowed, provided it is a branch of non-resident or a foreign company. And head office is outside India, branch is in India, either actual administrative and general administrative expenditure which is incurred by head office and it is attributed or it is attributable to Indian operations, actual versus 5% of adjusted gross total income, whichever is lower will be allowed, excess will be disallowed. This section also we discussed in PGBP chapter. So let me remind you with the same example. Suppose in Google India, Google is a branch in India, head office is located in USA. Head office has incurred some expenditure in terms of Indian rupees of rupees 800 crore. Expenditure incurred in dollars but converted into Indian rupees is 800 crore. Out of that, 80 crore is a general administrative expenditure and 720 crore is the other expenditure. In that, step number 1, other expenditure to be ignored. No deduction will be allowed for Indian branch making payment to Google head office outside India. No deduction will be allowed for this other expenditure. Deduction, if at all, will be allowed for only 80 crore and that too not entire 80 crore, the general administrative expenditure, only that much part of the 80 crore which is attributable to Indian operation. Attributable to Indian operation, for example, in this example is 8 crore rupees. So how much deduction will be allowed? So answer, deduction will be the 720 crore is gone only. Google India, the Indian branch may reimburse or may pay something to head office with regards to these 720 crore. Payment is allowed, deduction will not be allowed for income tax purpose. So supposingly Google Indian branch, Google Incorporation, how much deduction will be allowed? So answer, first you find out how much is the adjusted gross total income. We have to take 5% of that. Adjusted gross total income, in the absence of any clarification, we presume that income before deduction of head office expenditure which is 100 crore, this only is adjusted gross total income. So deduction less deduction under section 44C will be lower of the following two, either actual general and admin expenditure of head office which is attribute. How much is the actual? Actual is 8 crore rupees, friends, we just discussed here, 8 crore rupees. Either 8 crore or 5% of adjusted total income, And adjusted gross total income or adjusted total income is not given specifically here, so we assume that 100 crore only is a adjusted gross total income. The 100 crore into 5% will be 5 crore, whichever is lower. Google India, the Indian branch, will have to pay 8 crore to Google head office. Agreed. Pay 8 crore, no problem. Deduction will be for 5 crore. 95 crore will be the income chargeable to tax in India. Okay, same thing with same example we had discussed in PGBP chapter also. Okay, what if the actual average total income GTI, adjusted GTI, is negative? Adjusted GTI means what? So first of all, adjusted GTI means GTI of the current year, gross total income, before claiming this deduction and before claiming two brought forward items and before claiming chapter 6A deduction, before claiming 44C deduction. Obviously that's what we are finding out now, what are we how much we are allowed to deduct. Therefore it has to be before deduction of this, before deducting chapter 6A, before set off of brought forward loss and before set off of brought forward unabsorbed depreciation. And the last point, if the current year's adjusted GTI is negative, then 5% of the same will also be negative. Then do one thing, ignore the negative figure of the current year. Instead of adjusted GTI, if it is negative, adjusted total income is negative, take 5% of average of the last 3 years adjusted total income. Current year you ignore, go backwards, take the average of last 3 years. However, there is a further clarification which is not that important from exam perspective, that's why I have not covered here. If all the last 3 years did not have positive income was only in year 1 and year 3. There was income assessable to tax only in year 1 and 3. Then don't take total of last 3 years and divide it by 3. Just take the total of year 1 and year 3, total of those years in which you had positive ATI, positive adjusted total income, and then divide it by 2. And supposingly last out of 3 years positive income was there only in the first year, next 2 years there was a negative income, then don't take average of 3 years or average of 2 years, take total of only that particular year in which there was a positive adjusted total income, and adjusted total income of that year becomes adjusted total income of the current year. Take 5% of that. Simply in current year negative, then only go backwards. Current year negative, then go backwards 3 years. Out of 3 years, wherever negative, ignore negative years, only take positive divided by number of years. Okay. Then we have exemption till presumptive taxation is over. As far as exemption under section 10 is covered, I will record a part 2 of this video, because exemption under section 10 series, there are multiple sections which will be resulting into lot of time and it is less important. Only some clauses of section 10 are important, so I am skipping it entirely and I am jumping to the next concept, TDS. Okay. And now I am jumping to the next concept, TDS. This is something which we already done within TDS chapter. In TDS chapter there were 41 sections. Out of 41 sections there are 20 sections where the payee could be non-resident. Either payee has to be non-resident, like section 194E, if you recollect, payee is a non-resident sportsman, or payee is a non-resident association institution, or a payee is a non-resident entertainer. Either payee should be, so for this section payee has to be non-resident. Payee has to be non-resident. And there are other sections also, like section 192 salary, or 194B, double B, winning from lottery, crossword puzzle, card game, etc., where the payee could be resident or could be non-resident. Payee could be resident or non-resident. So there are 20 sections where the payee has to be or could be non-resident. These 20 sections we are already done with in TDS chapter, we are not repeating it again. Then there were some notes, rule 26, for which I will be recording video separately. In case when you are making payment to any non-resident and you are paying in foreign currency, then currency conversion, you are paying $1 lakh to some non-resident and the rate of TDS is 20%. So out of $1 lakh which you are paying, you are supposed to deduct TDS at the rate of 20%, which amounts to $20,000. $80,000 you paid. Now you could pay $80,000, that's fine, but TDS has to be deposited in government account in terms of Indian rupees only. Then what to do? The answer, will have to convert TDS amount from dollar to Indian rupees. Agreed. At what rate? Answer, by applying telegraphic transfer buying rate, TTBR of State Bank of India. That's a fixed thing. In entire Income Tax Act we follow TTBR. That is okay. Now what? Then, but as on which date? So answer, TTBR as on the date on which tax is deductible. TTBR as on the date on which tax is deductible. When is the tax deductible? Answer, tax is deductible either at the time of making actual payment, the payment date, or the date on which payee account is credited, whichever is earlier. The telegraphic transfer buying rate as on the date on which the tax is deductible shall be applied. Then section 195A, grossing of principal, which is not that relevant. So refer to TDS chapter for about details. 206AA is a section part of TDS chapter which says while making payment to a payee does not have a PAN number. Payee no PAN number, or payee or Aadhaar number. Whether payee is resident or non-resident, if he does not have the PAN number, then tax shall be deductible at highest of the following three rates. Either at the rate in force, that is the rate given in Finance Act, or the rate prescribed in the Income Tax Act, or at the rate of 20%, whichever is highest. However, this concept does not apply and the TDS will be at normal rate in two sections, 194 LC and 194 LD. Whether payee is FII, foreign institutional investor, then TDS will be at normal rate only. 206AA also does not apply to non-resident payee, such a non-resident payee who does not have PE in India, branch in India, factory, shop, showroom, godown. Then CBDT issued a circular which we are done with in TDS chapter. CBDT issued a circular stating that if the payee is non-resident and does not have PAN number, then instead of PAN number, payee non-resident will have to give following details. TDS at higher rate of 20% will not be deducted if following conditions are satisfied. Number 1, income which you are paying to non-resident should be interest, royalty, FTS, or payment for transfer of capital asset, and the non-resident furnishes the following details: name, address, contact number, email ID outside India, plus TRC, tax residency certificate from the country of his residency, and the TIN number, tax identification number. Name, email ID, contact number outside India, address outside India, tax residency certificate from the government of that country of which it is resident, and tax identification number, TIN number, or any other kind of unique identification number in case where payee is non-resident and not furnishing PAN number or does not have PAN number. All the above mentioned information will have to be furnished in TDS return also. Then in the TDS chapter, one was 206AA and 206AB. 206AA means without PAN number of the payee, and 206AB is a section applicable a higher TDS while making payment to any person who has not filed IT return of the last year. Non-filers, while making payment to a non-filer is called as a specified person. By whatever name you call him as, he is a non-filer. While making payment to a person who is a non-filer, provided he was required to file the IT return, specified person, then TDS will be either at double the rate applicable, twice the rate applicable, or at the rate of 5%, whichever is higher. Provided he has not filed IT return, three conditions. Number 1, he has not filed IT return of the immediately preceding previous year. Second, time limit has also expired. Due date to file return has expired. And third condition, TDS plus TCS combined together of the last year is 50,000 or more than 50,000. This is second condition, this is third condition. All the three conditions are satisfied, then we will call him as a specified person. Then except for TDS under these sections, the TDS shall be either at twice the rate applicable or at the rate of 5%, whichever is higher. This concept, TDS at a higher rate, which we are already done with in TDS chapter, does not apply, if you recollect, to a non-resident, to the non-resident payee who does not have a branch in India, does not have PE in India. Similar concept in 206CC for TCS chapter, TCS without PAN number, and then 206CCA, TCS while receiving payment from someone who is a non-filer. Here, without PAN number, does not furnish the PAN number, collectee does not furnish PAN number, then TDS will be at twice the rate applicable or 5%, whichever is higher. 206CC not to be done, that's okay. And then there are exception to 206CC, that same exception, non-resident. Non-resident not having PE in India will not be subjected to higher TCS or TCS at a higher rate just because he does not have PAN number. 206CCA, receiving payment from non-filer, same as 206 AB for TDS. It says IT return, the person from whom you are supposed to collect the tax. That is, you are collector, he is the collectee. Person who is the collectee has not filed IT return for the immediately preceding assessment year. That's condition 1. Due date to file IT return has expired. That is condition number 2, as on due date as in 31st July, 31st October. And third condition, TDS plus TCS for the given last financial year for which IT return is not filed is 50,000 or more. Then TCS will be at twice the rate applicable or 5%, whichever is higher. This concept does not apply exception to a non-resident collectee who does not have PE in India. Exactly same exception everywhere. Non-resident not having PE in India, no need to collect tax or deduct tax at a higher rate. Then if you recollect minimum alternate tax chapter, MAT will not apply to a foreign company, to foreign companies if some conditions are satisfied. 3 sets of conditions given in explanation 4 to section 115 JB or explanation 4A. Explanation 4 has got 2 sets of condition, A and set B, either of them, A or B. First set, foreign company on whom we are trying to apply MAT, foreign company is resident of such a country with which India has a DTAA. India has a DTAA and DTAA is there, plus that foreign company should not have branch in India, should not have a PE in India, permanent establishment in India. Then no need to apply minimum alternate tax chapter. MAT will not apply to such a foreign company which is coming from a treaty country and they don't have a branch in India. Second set of condition, either A or B. B is if there is no DTAA between government of India and government of that country from where foreign company is resident, plus registration relating to companies is not required. Registration relating to companies is not required. You will have to remember these conditions. Theory questions on this we have already discussed, they have already come in the exam. And 44, last one, explanation 4A. Last one, explanation 4A, it says that if the total income of foreign company comprises only of those incomes which are presumptive taxation, 44B, BB, BBA, BBB. Here government has forgotten to introduce 44 BBC. I have also not included. So it's not a printing mistake. I have not missed out anything. I was observing whether government has covered or not. The government has not covered here in explanation 4A to section 115 JB. So MAT will not apply if income declared in the IT return comprises only of presumptive taxation income, which is covered by these 4 sections, and assessee company has declared his income in accordance with these sections. Same way Aadhaar number as per government notification dated 11th May 2017, no need to remember the date or the notification number. Aadhaar number requirement does not apply for non-residents or those who are not citizens of India. They are exempted from the requirement of quoting their Aadhaar number. Apart from those who are staying in Jammu Kashmir, Assam, Meghalaya, if you recollect Jammu Kashmir, Assam, Meghalaya, or those who are 80 years and above at any time during the previous year. Barring these 2 people, non-residents and non-Indian citizens are not required to apply for PAN number. Sorry, not required to apply for Aadhaar number. Right? Even PAN number also non-residents are exceptions, but Aadhaar number also as per CBDT. Okay. Then some provisions pertaining to capital gain chapter applicable to non-residents. So in capital gain chapter, there was section 47. Section 47, certain transactions not regarded as transfer. So this, out of those around 33 transactions which are not regarded as transfer covered by various clauses of section 47, here we will be discussing 9 out of them. And apart from that, we will be discussing section 2 clause 14, subclause A, subclause B, subclause C, that is definition of capital asset. So first we will be discussing capital asset definition, which is not all that important. Section 2 clause 14 has 3 subclauses, subclause A, subclause B and subclause C. If you recollect definition, property of any kind, capital asset means property of any kind held by assessee, whether connected with his business profession or not. We are done with this in capital gain chapter. Then second point, securities held by FII. So in this chapter of special provisions for non-resident, we have to discuss only this point ideally. securities held by FII in accordance with which they have invested in accordance with SEBI guidelines, and virtual digital asset. Even virtual digital asset is also not that important. So from exam perspective, remember that when you apply capital gain chapter to foreign company, non-residents, FII, FII is ideally foreign company. MAT will not apply. Aadhaar number they are not required to apply, it's a company. PAN number also not required, but if they don't have PAN number, then they will have to furnish name, address, email ID, TIN number, TRC, etc. And for them, securities will not be considered as a closing stock, will not be considered as inventory. Income will not be taxable under the PGBP, but income will be taxable under the capital gain. It will be considered as capital asset. Now section 47, certain transactions which do not amount to transfer. Very first one, we are already done with it, so I am going little faster in capital gain chapter. Section 47 clause 6a, in case there is amalgamation of two foreign companies, let's say Coca-Cola USA from USA, foreign company merging with Pepsi USA, and they both combine together forming a new company, Copsi USA. Then Indian government technically has no right to interfere and charge tax because income is not accruing in India, asset is not located in India. But in this transfer, if that what is getting transferred by Coca-Cola to Copsi is shares of Indian company, Coca-Cola has a 100% wholly owned subsidiary in India, WOS, wholly owned subsidiary called Coca-Cola India Private Limited. Shares of this company got transferred from Coca-Cola USA to Copsi USA. Shares of Indian company get transferred, then section 911 will get triggered, and accordingly Indian government will have a right to charge tax. But if some conditions are fulfilled, then we will not charge tax to this company, transferor company Coca-Cola USA. Which condition? Two conditions. Number one, 25% shareholders of Coca-Cola USA continue to be the shareholders of Copsi USA, and this transaction does not attract tax on capital gain in the country where the transferor amalgamating foreign company is incorporated. Transferor amalgamating foreign company in our example is Coca-Cola USA. Right? Same way, instead of shares of Indian company, now what is getting transferred in case of amalgamating foreign company to amalgamated foreign company, what is getting transferred is shares of another foreign company, but such a foreign company which derives its value substantially from shares of Indian company or assets in India, then that company shares according to explanation 5, 6 and 7 to section 911, it will be deemed to be located in India. Shares of that foreign company will be deemed to be located in India. Same two conditions, 25% shareholders should continue from here till here, and there should be no tax on capital gain on this transaction in foreign country wherever amalgamating foreign company is located. Okay, which two conditions? 25% shareholders will have to continue, and transaction does not attract tax in the country where foreign company amalgamating company is incorporated. Third one, same thing for demerger. Twice we discussed for amalgamation, again 2 times for demerger. Section 47 clause 6c, you don't need to remember the clause number. Demerge foreign company transferring to resulting foreign company. Both of them are foreign company, transferor, transferee. India should have no right to interfere, but if what is getting transferred is the shares of Indian company, that's it. Indian government will have a right to charge tax according to section 911. Okay, for example, there is a foreign company, Pineapple Incorporation. Same example we had taken in capital gain chapter also. You can see my video there. Pineapple Incorporation is a foreign company, USA located. It is getting demerged, and as a result of demerger, the old company, Pineapple, demerged company, name is changed to Pine Incorporation, and the new company, resulting company is formed called Apple Incorporation. Indian government should have no right to charge tax, but what is getting transferred by demerged company to resulting company is shares of this 100% wholly owned subsidiary company in India called Pimple Limited. Pimple Limited shares are getting transferred to this new company. Then in such situation, it is technically a transfer, but in India we will not regard it as transfer, we will not consider it as transfer provided two conditions are satisfied. In case of amalgamation of two foreign companies, 25% shareholders have to continue, but in case of demerger, 75% shareholders have to continue. 75% of shareholders of demerged company continue to be the shareholders of resulting company, and second condition is same, such transfer does not attract tax on the capital gain in that country where demerged foreign company is incorporated. Then 47 clause 6cc, again same thing, demerged company transferring to resulting foreign company. Both of them are foreign company. What is getting transferred is not the shares of Indian company. What is getting transferred is shares of another foreign company. Such a foreign company which derives its value substantially from assets located in India or shares of Indian company. Then as per section 911 explanation 567, it will be shares of this company will be deemed to be located in India. Since shares are deemed to be located in India, it will be regarded as transfer taking place in India. Capital gain will be deemed to be accruing arising in India. It will not be regarded as transfer if two conditions satisfied. Same two conditions, 75% shareholders continue to be the shareholders of resulting company, and such transaction does not attract tax in the country in which demerged company is located. 47 clause 7a, 7AA, 7ab. Quickly, 7a, one non-resident transferring to another non-resident outside India. Condition 1, condition 2, buyer seller both are non-resident. Condition 3, transaction taking place outside India. What is getting transferred is bonds or GDRs of Indian company referred to in section 115AC. Then it will not be regarded as transfer. Okay, this we discussed in special rates of tax chapter also. This we discussed in capital gain chapter also. This is the third time we are discussing. In your notes it's given this way. Okay, 47 7AA. Here also same thing, asset gets changed, remaining three conditions are same. Condition 1, seller is a non-resident. Condition 2, buyer is a non-resident. Condition number 3, transaction takes place outside India. But fourth condition, asset is changed. Earlier the asset was bonds or GDRs of Indian company referred to in section 115AC. Now this time it is rupee denominated bonds of Indian company RDB, which is also called as masala bonds. Okay. Then the next is 47 clause 7AB, everything remaining same assets what we discussed in earlier 2 points, but now the transfer is not taking place outside India. Unlike outside India, fourth this condition, here transfer is taking place in India only, but on a stock exchange, recognized stock exchange, which is located in an IFSC, International Financial Service Center. Transfer of number 1 bonds or GDRs referred to in 115EC, something which we discussed in 47 clause 7A. A rupee denominated bond, something we discussed in 47 clause 7AA. But here what is happening? Transfer is taking place outside India. Now here in 47 7AB, another asset is derivative. That's one extra point which was not there in previous 2 points, and transferred by non-resident on a recognized stock exchange located in any IFSC, and the sale consideration is entirely in foreign currency, right? 47 clause 7B, again same 4 condition, asset gets changed. Earlier it was bonds debentures of Indian company referred to in 115AC, then it was rupee denominated bond. Now it is government security carrying periodic payment of interest. Bracketed wording remove, government security. Condition 1, transferor is non-resident. Condition 2, buyer is also non-resident. Condition 3, transfer takes place outside India, but the asset gets changed. Asset is government security carrying periodic payment of interest. 47 clause 7B, and the last one is 47 clause 7B. This is how it is given. 47 clause 10A, if bonds or GDRs, no, not bonds or GDR, only bonds. This time it is only bonds. In 47 clause 7A, it was bonds or GDRs of Indian company referred to in 115EC. This time only bonds. Bonds of Indian company referred to in 115EC are converted into shares or debentures of any company, then it will not be regarded as transfer. Why here GDRs are not covered? Unlike this, because GDR itself is in the form of shares. GDR means global depository receipt. 1 GDR is equal to 5 equity shares approximately. So GDRs cannot be converted into shares. It is called as dematerialization or rematerialization. GDRs can be, shares can be dematerialized, you will get GDR, and GDRs can be surrendered and it can be rematerialized into shares. Those shares will be converted into physical form. So here bonds of any company, bonds are converted into shares or debentures of any company, will not be regarded as transfer, accordingly no capital gains tax. That's it for now. This we are ending here. In the next session we will be discussing place of effective management, part 2 of this chapter, and we will be discussing exemption under section 10. These 2 points I will be covering in the next video. Thank you very much for now. Wish you all a very good luck. All the best. See you in the next video, part 2 of this chapter.